Good afternoon. This is Brad Dennis with BIS Commodities. And this is your weekly wrap-up for the first complete week of May. Starting off, talk about cattle a little bit. This week we've seen firm boxes, and over the past couple weeks we've seen the transition. April's gone off the board. We're looking at June at a big discount to where cash is. Cash was rumored to be about 157, bid out there at 161 was the asking price out of the cattle guy today. So not much trading, some light trading around 160, 161 here in Iowa, not big numbers. A lot of people are anticipating that June contract to catch up to where the April was once the April went off. Right now, like I said, you've got a very positive basis between where the cash is and where the futures are, which is an attractive, or it's attractive to a guy that's had his June hedged up. You've got a lot of an $8, $10 basis on that, so you'll probably see a little bit of cattle go that way. We've also seen hogs rally up in the past couple weeks too. If you look at cash price on hogs, you'll see that cutout is over $10 higher, whereas the national cash average is up about $14 over the past 2 weeks. A lot of this is attributed to the bird flu that has gone through the Midwest states here. People are feeling, well, at least speculators feel that there's going to be a lot more need for pork. People will pass over the production of poultry. It looked like, though, this week, even though we did have this avian flu outbreak, that egg sets were up this week. So some things don't add up there a lot of times. So moving on from the livestock, going over into the grain, and this week you look at the first 3 days of the week and then you look at the last 2 days. First 3 days, you've got the first full week of May, so you had your investment money, you had your funds come in those first 3 days. They couldn't quite support it enough on Tuesday or on Wednesday, so we came off a little bit. Thursday was a nothing day. Today, pretty quiet as well. People are getting prepared for next week's S&D report. They were also getting prepared or paring back their positions for this morning's non-farm payrolls report. So I'll get to that economic data in a little bit, but as for grains right now, you're looking at that rally in corn, brought D's corn up off of about the 370 level. You look at the contract low of corn, it's 365.5. You've got a major report coming out of the government, another report coming out of the USDA. Guys wanted to pare back their positions. They bought back their shorts down around that contract low. See what happens over the next couple weeks. Also, you're looking at not taking out last week's high of 388 and change. So what we have is lower lows, lower highs, so still downward momentum in the corn market. It just kind of depends on what the government has to say now on Tuesday. I wouldn't be aggressive on the buy side until you take out the previous week's highs. As for the downside, it could be one of those situations where weather does look good. You might just continue to bleed this thing to the downside. You get through a 365 area, then you might actually accelerate things. So those are kind of the parameters that I'm looking at. On the bean side of things, a lot of talk about Argentine strike. You know, if there's a strike down there, they're going to make China worried about buying beans, so China's going to come back here and buy beans. Well, we haven't seen any announcements about China buying beans here, and you're still looking at South America as having the cheapest beans down there. So once you get through this strike, and I believe the labor markets are supposed to be talking on the 14th or 15th of next week, that's going to be one less bullish scenario for beans. Beans should be about 20-25% planted by Monday as well, so we're going into the ground well. Any kind of weather premium can start to be taken out of that a little bit. And as far as this week's move, I think we were up about 11 cents when it's all said and done, and it's kind of similar to the corn where you couldn't take out that technical area. You look at November beans, and we got down to 38 earlier in the week. 33, 34 is kind of the last lows that we've had on that, and we couldn't really press through it. So a little bit of short covering ahead of today's non-farm payrolls and next week's USDA report. Now that USDA report is going to be on Tuesday of next week at 11 o'clock. Really kind of looking at about, right now we're at a 185, let's say, carry out on corn. Looking probably for the estimate to be about 175 for this year's crop. So we're going to bring down those stocks a little bit. And when you look at the acres that we have out there and you put in whatever trend line should be in the mid-160s, we've got a lot of demand out there, so we have to grow a crop. So it could be a little bit of a surprise on that corn. Now, if that corn does rally, though, like I said, we've got to take out those previous week highs so that we can get some momentum from some short covering out there. Over in the beans, a little different story. We're looking at, a 370 carry out here. So old crop 370 might go down 20 million bushels or so because of the export sales that we still see coming through. But on the other hand, the new crop is going to be over 400. Possibly. So you've got some pretty big numbers out there on beans still that we're going to be looking at. You've held that bean price up there, so the bean to corn ratio is high. It's saying, hey, still plant bean acres out there. And this next week could be the first week we ever see over 100 million metric ton of bean stocks in the world. So you get past Thursday or next week's Tuesday. This bean market might be saying its last hurrahs. We'll see, because you've always got to take into account the macros when you're talking about the bean market. Seems like speculators love to trade the bean market, and a lot has to do with where the macros go, and that's what we were talking about today with the non-farm payrolls. And actually that number came out, and a lot of people have been using the Goldilocks, and that's exactly it, not too hot, not too cold. Came in at 223,000 on the non-farm payrolls. Now ADP data on Wednesday was about 115, or 150, let me say. So we were looking at a disappointment here. It came in, jobs are being created again. We had the big scare with our GDP number of only up 0.2 or up 0.2 last week, and that really brought the dollar back down. Everybody's looking at, hey, that might be just a little blip on the radar, and that we're recovering after that first quarter. This is a good number for non-farm payrolls because it says that we're expanding, we're creating jobs. We're not expanding too quick, so the Fed has to run in there and hike rates right away. But it does say that we can keep looking at a time frame in which rates will be hiked, and that's basically what you're trading out over there. Keep an eye on the bond market. Bond 10 years got down to 2.25%, I think, or 2.24. If we can take out that yield and bonds go down to about a 126 on the note, then you're looking at higher yields out there, and they're starting to price in a quicker time frame on that rate hike. So now for payrolls, Goldilocks scenario, GDP was poor for the first quarter, but this is saying that we're kind of getting a little bit better as the year goes on. First quarter had the union strike out on the West Coast, and you also had terrible weather in February, and that can do it. And we can see a rebound here. We've seen ISM data and we've seen PMI data that have continued to point towards expansion in our economy over that 50 level. So that's definitely a positive moving forward here. You also want to see a little bit more of a crude stabilization too. You'd like to see a little bit more carry in the crude market. You got to remember, we still are talking about a large supply out there. That has not changed at all. And the other thing that kind of shocked the crude market this week was the gasoline demand was down. So we've had this run up in gasoline from about a $1.70 I think we traded close to 210 this week, and we're going to close the week down around $1.98. So, there's a lot of give and take in this, and what people will pay, where those monies go, and where's the momentum at. And right now, I'm looking at the dollar index. All right, that rallied up to 100. We came back down to 94. This number out of the non-farm payrolls probably says, hey, 94 is going to be a little bit of a basing area, and we might trade 94 to 98 for the next month or so. That would tell us that rate hikes are still going to be seen at some point during the end of the year. Very, very based on economic data still coming in strong. So what we're looking for in corn and beans for next week, I'm looking for basically staying in this range. If we come out with numbers, the average guesses for new crop, the 1.750 in corn, and let's say 430 for beans next week, you're probably still staying in your same range, and it's going to be kind of a very weather related trade, and the weather right now looks great. We should be at about 70% planted in corn on Monday. Beans, like I said, 20 to 25% planted. So not a whole lot of weather premium needs to be in that market right now. It'll be added back quickly if we see some kind of situation, but for right now you don't really need it. So back and forth trade on the corn and beans. Watch the economic data. I think with it being perfect weather, you're going to see the corn and beans play off the macros a little bit more, or be influenced a little bit more by them. It doesn't want to be a stagnant market, so look at those economic figures that come out, and anything that does help the dollar out might keep a little bit more pressure on those ags. So that is it for this week. So broadcast over.